Hi everyone, so today let's revise strategic analysis of operating income. So this is one of the important chapter, category B chapter in SCMP. So let's start. So this is the only notes that I have. So it's like 1, 2, 3 and the fourth side. So it's very simple and let's just finish in 10 minutes. Yeah, let's try. So first thing is first, like what is it? It is divided into three main categories. So this revision I have taken this from Atul sir. So if you want to refer his video, you can definitely refer. This is just a quick bite of whatever was covered in the video. So what is it? Strategic analysis of operating income has been divided into three main categories. Okay. So what is the strategic analysis of operating income? You have something called operating income. You have an income, correct? So how do you analyze? Like strategically, how do you analyze the operating income that you have received? Okay. So first one is the profitability analysis. What is this profitability analysis? How are you earning the profit? Correct. So in the income. So what is the profit analysis of that? So how is it? So the strategic profit analysis, direct product profitability, customer profitability analysis. These are the 3 points under profitability analysis. So second point is activity based management. The third point is activity based budgeting. So these two things we'll see later. First thing, very important, the profitability analysis. So first one is strategic profitability analysis. Under strategic profitability analysis, you have three things. Like how do you strategically analyze the profit? So first one is growth component. Under growth component, it is the growth. The term itself says it is a growth. Because of the growth, how much profit have you earned? Then second one is price recovery component. Because of the price recover, you have recovered the price, and because of which how much profit have you earned. Then productivity component. Productivity means if you have done something in the production cycle, like if you have done something really great in the production activity, then how much profit have you earned because of that. So under this profitability analysis, the first point is strategic profit analysis, under which we have 3 points. One is growth component, price recovery component and productivity component. Under growth component, we have two things. So due to change in sales units, growth component due to change in sales units. Sales units can be changed because of two reasons. One is market size itself is changing. The other one is market share is changing. Market size changes because not because of your efforts. It's because market itself is reacting in a certain way. Like example, mask market went really up during Corona. So market size itself changed. You did not put any. You didn't put any effort for that. So it just changed, right? So in the market share change, you have put some effort, that's why it has changed. Example, like you are producing a shampoo and it is a paraben free shampoo, so customer will definitely recognize your effort and there will be a change in the share. So that is what it is. So under profitability analysis, strategic profit analysis, growth component. Under growth component, two main reasons. One is market size change, market share change. Then we have something called price recovery component. Price recovery component, under which we have change in revenue and cost due to change in prices. Price recovery component is nothing but change in revenue and cost, change in income and cost due to change in prices. Then we have productivity component. Under productivity component, you have change in cost due to change in efficiency. Change in cost due to change in efficiency. So this is under productivity component. So now we have understood what is growth component, change in size, change in share. Then price component, price recovery component, which is change in market revenue and cost because of change in the prices. Productivity component, productivity component, change in cost due to the efficiency, change in efficiency. Then there is something called reconciliation statement. How do you prepare this reconciliation statement, which is important? Then operating income of last year, you take the operating income of the last year. Then you have change due to market size, then change due to productivity, change due to product differentiation. Okay, so I don't think so we'll be able to complete within 10 minutes. Still, I'll try within at least 15 minutes. So now I just wanted to put it across. So reconciliation statement, we have operating income of last year. Last year operating income you have taken. Then plus or minus what? Change in market size. Here we have something called market size directly taken from here. Change in market price. Then change due to productivity. Change due to productivity directly from here we have taken. Change due to market size. Change due to productivity. Then change due to product differentiation. Change due to product differentiation. We have something called change due to product differentiation. This change is because of two things. Product differentiation change is because of two things. One is price recovery component. The other one is market share. Price recovery component, the other one is market share. Okay. So we have understood. So directly we have taken the market size change due to market size, productivity component, and these two things. One is market share, the other one is price recovery component. Okay. So these three things can be added or subtracted based on whatever the criteria is. So you will get the OI, that is operating income of the current year. Then note, what do we know? What is the main point here? The change due to market size. The change due to market size is equal to growth component, entire growth component into market size, the percentage of market size divided by total change in the sales unit. Percentage of change due to market size divided by total change in the sales units. That is very simple and you know it. Then direct product profitability. What is this direct product profitability? Used primarily within retail sector. This direct product profitability. So here we had three things. One is strategic profit analysis, which you've already done. Direct product profitability. How do we get this direct? Where do we use this? We use this direct product profitability in retail sector. Attribution of purchase price and other costs such as warehousing, retailing and transportation. WRT. Wrote right. Okay. WRT, warehousing, retailing and transportation. Transportation also includes distribution. So this is direct product profitability. DPP statement, how do we prepare that? Selling price, that is selling price per unit minus cost of goods sold. Then you get gross margin per unit minus direct product cost per unit. So this is selling price minus cost of goods sold is nothing but purchase price. So gross margin per unit you got minus direct product cost per unit. Then this direct product cost is distributed between warehousing, retailing and transportation. Like for warehousing, for retailing, for marketing and all those things. Then transportation, to transport that. So how much have you spent on that? That will be deducted. So that then you get direct product profit per unit. That's all. So this is based on this direct product cost apportioned based on the volume of the products. Then we have something called customer profitability analysis. The third point is customer profitability analysis. What is customer profitability analysis? One is selling same product to different customers. Take an example of sari. So you have a sari, for you it costed around 1000 rupees. For customer A you sold it at 1500, customer B you sold it at 1800, and for customer C you sold it at 2000. So the same product you sold to three different customers at different prices. So that is what is customer profitability analysis. Then gross or list selling price per unit. How much is the gross selling price? Then minus sales return minus discount. How much discount have been given? Then net sales per unit. You get net sales per unit minus variable cost of production or buying cost. Then contribution margin per unit into number of units. Then you get total contribution. How much is your total contribution? Then we have total contribution. From here we start. The total contribution we have. So total contribution minus overhead cost relating to customer activity. Minus overhead cost. If you have any overhead cost based on the ABC analysis, you take that. Then you get total profit per customer divided by number of units sold. Total profit per customer divided by number of units sold. Then you have profit per unit per customer. So then there's step 2, analysis part. So step 1 what you did of step 1 of customer profitability analysis, you figured out how much is the profit. Now we'll analyze why there is so much profit. Analyze, there is something called general comment, special comment. Under general comment you say total profit per customer and profit per unit per customer. then how much is the discount, then how much is the overhead cost related to the customer activity, like based on their order processing, delivery, customer visit, others. So all these things will be commented in the general comment. Special comment like maintain good relationship with the customer who is profitable, then review discount or overhead cost of non